Welcome to the Deep Dive. Today, we're jumping straight into South Korea's financial sector. Our sources show this fascinating picture, really, of high-stakes tension.
Yeah, you got these huge multi-trillion won policy plans pushing investment one way.
Right, but then you also have this really fierce, almost uncompromising regulatory scrutiny clamping down. Things like capital adequacy, past mistakes, it's all coming under the microscope.
Exactly.
Okay, let's try and unpack this a bit. So the big financial groups are responding to these strategic policy shifts, right? They're putting massive amounts of capital into national growth plans. But at the same time, the regulators are tightening the screws everywhere. I mean, from insurance companies' solvency metrics all the way to cracking down on how investors lost money on complex products.
It really feels like the government is actively steering the ship, directing capital, but also demanding serious accountability.
Yeah, accountability is a key word here.
And what's really fascinating is understanding the why behind this big policy wave, this alignment. It's not really voluntary in the traditional sense. It feels more essential, for companies to stay relevant. The government's pushing this idea of productive and inclusive finance, which basically means capital has to flow towards innovation, towards regional development. And we're seeing these pledges, 80, 100 trillion won, even more.
Huge numbers.
Yeah. So this deep dive, it'll show you what's in those pledges, but also, crucially, the kind of brutal market forces that are simultaneously hitting traditional areas like credit card companies. Their revenue streams are just dissolving.
Right.
You really need to see both sides, the push and the squeeze, to get the full picture of what's happening in Korean finance right now.
Okay, that sets things up perfectly for maybe the biggest number we saw. This is where it gets really interesting. NH Non-Yip Financial Group. They're making this huge commitment, 108 trillion Korean won over 5 years.
Yeah, massive.
For their NH Mutual Growth Project. And like you said, this isn't happening randomly. It came right after a call for action from the Financial Services Commission, the FSC.
That scale, 108 trillion, it's crucial. It's actually the largest pledge among the major groups we looked at. Worry committed 80 trillion, Hana pledged 100 trillion.
So NH is leading the pack here.
They are. And this is more than just, good PR. It's the private sector taking the government's productive finance concept and turning it into a real multi-trillion won pipeline for industrial innovation and regional growth.
It's how they're basically buying into the government's strategic economic direction.
Pretty much.
So let's break down that 108 trillion won, because, like you hinted, it tells us exactly what the government wants funded. It's split, mainly, into productive finance, that's the huge chunk, 93 trillion won, and then inclusive finance, which is 15 trillion. Let's go there, actually. What specifically is that 15 trillion for inclusive finance funding? It sounds important.
Oh, it absolutely is. Think of it this way. While productive finance is about boosting industries and tech, inclusive finance is the social support piece.
Okay.
That 15 trillion is really focused on making sure financial access gets to people who are often left out. So small shop owners, lower income families, communities out in the regions that need reliable financial services.
So it's about spreading the benefits beyond just Seoul and the big tech hubs.
Exactly. It tries to ensure the growth isn't quite so concentrated.
That makes a lot of sense. Okay, now for the really big bucket, that 93 trillion won for productive finance, where's that massive investment going?
Right. So this breaks down into three quite specific areas. And each one, you can see it lines up directly with a national policy goal.
Okay.
First up, the biggest slice, 68 trillion won, is for direct investment and lending. This money goes out through things called enterprise growth support loans.
So special types of loans.
Yeah, they're not just general business loans. They're really targeted. Think advanced strategic industries, specific regional industries that need a boost, and of course, startups.
Got it.
And it even includes things like relief support, maybe interest rate breaks, for companies hit by specific problems like, say, tariffs.
Okay, so that covers the debt side, pushing capital into those key sectors. The second area you mentioned, 15 trillion won, that's focused on equity.
Correct. 15 trillion won specifically for adventure capital or equity investments. This is about funding tomorrow's potential growth engines.
Right.
Part of this targets agricultural and food companies, which makes sense given Non-Hyup's roots in agriculture. But importantly, it's also about promoting new funding structures like business development companies, BDCs.
Okay, hold on. BDCs, business development companies, we hear that term cropping up more. For someone listening who might not be deep in finance, what exactly is a BDC and why is promoting them a priority?
Good question. Think of a BDC as a type of investment fund, but one that's specifically set up to list on a public exchange. Its whole purpose is to raise capital to invest in promising, often smaller, private companies.
Ah, okay, so it's a way to get public market money into private companies.
Exactly. They're important because they offer another channel for growth capital, one that's not just traditional bank loans or, closed venture capital funds. Encouraging BDCs helps diversify how growing companies get funded.
Excellent clarification, thanks.
Hmm.
And the final 10 trillion won piece of the productive finance puzzle that connects directly to government strategy.
Directly. 10 trillion won goes into what's called the National Growth Fund. This means co-investing alongside government initiatives, specifically mentioning the Korea Development Bank's Advanced Strategy Fund.
Right.
And maybe most revealingly, this pot of money directly supports the government's very specific regional development plan, the one known as the 5 regions, 3 special zones, or 5.31.
Okay, so let me see if I'm tracking this for the listener. This massive 108 trillion won commitment from NH Nongap, it's not just a big number. It's like a detailed blueprint, heavily influenced, if not directed, by the government, showing exactly where capital needs to go.
That's a great way to put it.
And it helps that you have figures like Chairman Lee Chan-woo, a former Vice Minister of Economy and Finance, leading the group. It really underlines that this is less about pure commercial choice and more about necessary alignment.
Precisely. The capital flow is being strategically directed to meet national priorities. It's about ensuring the financial sector serves that broader economic policy.
Okay, so now let's pivot. We've talked about where money is aggressively flowing in. Let's look at where it seems to be, well, drying up. While banks and investment arms seem to be thriving under these mandates, our sources show a really tough picture for the credit card subsidiaries within the big 4 financial groups, KB, Shinhan, Hana, Woori.
Yeah, the numbers here are just stark. They really show how quickly their influence is fading. If you look at the card companies' share of their parent group's total net income, it plummeted from about 19% back in 2015 down to just 6% by the third quarter of 2024.
Wow, 19 down to 6%.
Yeah. That's a massive, 3-fold drop in their contribution in less than 10 years.
That is just staggering, especially if the parent financial groups themselves are growing overall. And you said earlier their total net income grew, 170% in that time?
That's right. Huge growth overall.
So why are the card companies doing so badly? What happened?
Well, they've basically been hit by a double whammy. Regulatory pressure squeezing their fees, and technology just disrupting their whole model.
Okay.
While the parent companies successfully diversified into things like insurance, securities, higher margin stuff, the card companies just couldn't keep up. Their net income only grew about 17% over the whole period they got left behind.
Let's talk about that regulatory pressure first. The sources mentioned merchant transaction fees being cut repeatedly. How bad was that squeeze?
It's been crushing for their core business. Especially for smaller merchants, shops with less than 300 million won in revenue. The credit card fee went from 1.3% back in late 2015 down to just 0.4% today.
0.4. That's almost nothing.
Pretty much. I mean, if your main business is processing payments and taking a small percentage, and that percentage gets cut by 2/3, it's incredibly hard to make that model work anymore.
Yeah, no kidding. And then while they're dealing with that, technology comes along. The simple payment services.
Exactly. Things like Never Pay, Kakao Pay. They encourage people to behave in a cardless way. You link your card once to the app, and then you just use the app.
Right, the physical card becomes less important.
Yeah, its branding, its primary function, it all gets eroded. And what's more, even things like government consumption coupons, which used to heavily rely on people using their credit or check cards, are seeing less use. That dropped from about 72% usage via cards in 2021 down to under 69% more recently.
So the whole ecosystem around the traditional card is just weakening.
It's really struggling to justify its old structure and costs.
Okay, so we have this push for massive strategic growth in some areas and this really painful decline in a traditional consumer finance pillar. Which brings us nicely to the regulator's dual role, trying to foster that growth while also demanding really strict oversight and accountability. Let's look at 2 key examples, the Lot Insurance Capital issue and the Belgian fund investigation.
Right. The Lot non-life insurance case is fascinating because it sets up this potential legal and regulatory clash. The Financial Services Commission, the FSC, issued what's called a management improvement recommendation. It's a type of corrective action. Based on concerns about Lotha's capital adequacy, how much buffer they have against losses.
And what specific measure did the FSC point to?
They highlighted Lotte Insurance's basic capital. It was actually negative minus 247 billion won at the end of June. That resulted in a basic capital KICS ratio of negative 12.9%.
Negative 12.9%. Compared to what?
Well, the industry average was over 100%. And KICS, for listeners, that's the new risk-based capital standard in Korea, kind of like Solvency II in Europe. It measures how well an insurer can handle risks.
Okay, but here's where it gets tricky, right?
Yeah.
Because the controversy is all about which specific KICS measure they used. Laudar argues their overall solvency is actually fine.
That's exactly the point. The company and its labor union immediately pushed back. They pointed out that Laude's overall KICS ratio, the standard widely accepted measure, was 141.6% in September.
141.6%. That's well above the usual regulatory guidance level, isn't it? I thought that was 130%.
It is. It's comfortably above the 130% recommendation threshold.
So wait a minute. If the company is clearly meeting the standard requirement with the overall ratio, why is the FSC hitting them with corrective action based on this basic capital KICS ratio?
And that is the absolute core of the controversy. The argument from the industry and the union is that this decision is questionable because that specific metric, the basic capital KICS ratio, well, it hasn't actually been formally finalized as a binding regulation yet.
Ah, so the FSC is potentially using a metric that isn't even officially on the books yet to take action.
That's the perception, and that's the basis for the challenge. It creates this feeling that maybe they're using an unofficial yardstick to enforce action, possibly to push insurers towards being even more conservative.
That definitely sounds like grounds for a legal fight if Laude decides to go that route, as the union seems to be suggesting. It really calls the fairness of the enforcement into question.
It absolutely does. It highlights this tension between what the regulator wants firms to do, be super cautious about basic capital, and what the actual written rules currently say.
Okay, a really interesting gray area there. Now, shifting gears to consumer protection. The other big regulator, the Financial Supervisory Service, or FSS, is taking action over investor losses in this 90 billion won Belgian fund. This seems to be about accountability for how products are sold.
Yeah, this is a significant test of regulatory resolve under the current FSS governor, Lee Chan-jin. He's publicly promised that if their ongoing inspections find evidence of incomplete sales practices or internal control failures at the banks and securities firms that sold this fund.
Which were Korea Investment and Securities, Kookmin Bank, and Woori Bank.
Correct. If they find those failings, the compensation ratio offered to the victims who lost money and the fund lost pretty much everything, 90.9 billion won will be reassessed and likely increased.
Okay, but what's the really powerful signal the FSS is sending here about dealing with these past mistakes?
It's the commitment to apply any adjusted higher compensation ratio retroactively and equally to all the victims. And this is the key part, even for those people who already took the initial lower settlement offer.
Ah, so even if you already settled for, say, 20 or 30% back, you'd still get topped up to the new higher percentage.
Exactly. That initial voluntary offer was somewhere between 20 and 50%. This retroactive application is a very strong statement. It signals they're serious about fundamental reform, changing how products are designed and sold, rather than just letting firms get away with quick, lowball settlements to make the problem disappear.
It stops institutions from using those quick settlements to dodge deeper accountability.
Precisely.
Okay. So if we try and connect all these different threads, what's the big picture emerging here?
I think you see a South Korean financial sector that's being fundamentally reshaped, really, from multiple directions at once. You've got these top-down policy mandates driving huge investment flows.
Like the 108 trillion won plan.
Exactly. At the same time, you have market forces just gutting traditional business models like the credit card industry. And then layered over all that, you have this very assertive regulatory oversight demanding both rock-solid capital strength, even using potentially controversial metrics, and much higher standards for ethical sales practices.
So for you listening, the key takeaway here is that things are moving incredibly fast in Korea's financial world. Aligning with those big national strategic goals, like we saw with the massive funding plans, seems almost like the price of entry now for the major players.
Yeah, it feels that way.
But it's a high-stakes game. Any hint of regulatory ambiguity, like that Lotte KICS situation, or any past mistakes in how products were sold, like the Belgian fund, are being pursued really aggressively by the authorities.
No room for error, it seems.
We've covered a lot.
Yeah.
These huge capital commitments, the dramatic struggles of traditional business models, and these really crucial regulatory fights over solvency rules and consumer accountability. So as we wrap up, here's something to think about. We talked about NH, Hana, and Woori setting this incredibly high bar for productive finance support, 80, 100, 108 trillion won. What does that mean for the smaller, second-tier financial groups?
Good question.
They likely can't commit capital on anywhere near that scale. So how are they going to be forced to adapt? Do they have to reallocate their smaller capital pools differently? Will they be pushed into mergers to compete, or maybe forced to become hyper-specialized in niche areas to find their own strategic relevance in this new, very policy-driven market? Something for you to perhaps mull over or explore on your own.
Approximately 8 minutes, 15 seconds, based on 1,400 words at 170 WPM.